Stock selection for the defensive investor. The defensive investor is a type of investor who prioritizes safety and preservation of capital over high returns. When selecting stocks for a defensive portfolio, the focus is on finding high-quality companies with a history of stable earnings and a strong financial position. When selecting stocks for a defensive portfolio, look for companies with a strong balance sheet, including a low debt-to-equity ratio and ample cash reserves. This will help ensure that the company is able to weather any economic downturns or unexpected events. Companies with a history of stable earnings are typically less volatile than companies with erratic earnings. Look for companies that have a long-term track record of consistent earnings growth. Dividend-paying stocks can provide a steady income stream for investors, which is particularly important for defensive investors who prioritize stability. Look for companies with a history of consistent dividend payments and a reasonable dividend yield. Defensive investors should also consider the industry position of the companies they invest in. Companies that are leaders in their industry and have a competitive advantage are typically more stable than companies that are struggling to compete. While defensive investors prioritize safety over high returns, it's still important to ensure that stocks are reasonably priced. Look for stocks with a reasonable price-to-earnings ratio and other valuation metrics. Stock selection for the enterprising investor. The enterprising investor is a type of investor who is willing to take on more risk in pursuit of higher returns. When selecting stocks for an enterprising portfolio, the focus is on finding undervalued companies with strong growth potential. Key factors to consider when selecting stocks for an enterprising portfolio: valuation. The enterprising investor should look for stocks that are trading at a discount to their intrinsic value. This may involve analyzing a company's financial statements and using valuation metrics such as price-to-earnings ratios, price-to-book ratios, and discounted cash flow analysis. Enterprising investors should look for companies with strong growth potential, which may be indicated by factors such as a large market opportunity, a disruptive technology or business model, or a strong competitive position in a growing industry. A company's management team can have a significant impact on its success or failure. Enterprising investors should look for companies with strong leadership that is focused on long-term growth and shareholder value. While enterprising investors are willing to take on more risk, it's still important to invest in companies with a strong financial position. This includes a low debt-to-equity ratio, ample cash reserves, and consistent earnings growth. Enterprising investors should also analyze the industry dynamics and competitive landscape of the companies they are considering investing in. Look for companies that are well-positioned to succeed in a competitive market and have a clear competitive advantage. Convertible issues and warrants. Convertible issues and warrants are two types of securities that can be used by companies to raise capital. Both of these securities provide investors with the opportunity to convert their investment into shares of common stock. A convertible issue is a type of bond or preferred stock that can be converted into shares of common stock at a specified price or conversion ratio. Convertible bonds and preferred stocks typically offer a lower yield or dividend than non-convertible securities, but they provide investors with the potential for capital appreciation if the stock price increases. Companies may issue convertible securities to attract investors who want the potential upside of stock ownership but are also looking for some downside protection in the form of a fixed income or preferred dividend payment. Additionally, companies may issue convertible securities as a way to lower their cost of capital, as they may be able to offer a lower coupon or dividend payment due to the potential for conversion into equity. A warrant is a type of security that gives the holder the right, but not the obligation, to buy shares of common stock at a specified price for a certain period of time. Warrants are typically issued in connection with a bond or preferred stock offering and are often detachable from the underlying security, which means they can be bought and sold separately. Warrants can provide investors with the potential for significant gains if the stock price rises above the exercise price of the warrant. However, warrants can also be risky, as they can become worthless if the stock price does not rise above the exercise price before the expiration date. Companies may issue warrants as a way to sweeten the deal for investors and attract more buyers to their securities. Additionally, warrants can be used to reduce the cost of debt or preferred stock financing, as they are often sold at a premium to the underlying security. 4 extremely instructive case histories. Northern Pipeline. This case study involves a company that had a steady stream of income from natural gas pipeline operations. Despite the stable income, the stock price was volatile and prone to large fluctuations. American Telephone and Telegraph, AT&T. This case study involves a company that had a dominant position in the telephone industry. The company had a long history of paying dividends and had a stable business model. American Can. This case study involves a company that had a cyclical business model, with earnings that were tied to the overall health of the economy. The company experienced large swings in its stock price. Pay attention to the underlying business fundamentals and to not get caught up in short-term stock price movements. Columbia Gas and Electric. This case study involves a company that had a steady stream of income from natural gas operations. The company was acquired by a larger company, resulting in a significant increase in the stock price. Be cautious when investing in companies solely for the purpose of acquisition speculation, as the outcome of such speculation is uncertain. Focus on the stability of the company's operations and income stream rather than short-term stock price fluctuations. Shareholders and management's dividend policy. Dividends are a crucial component of an investor's total return. Investors should pay attention to a company's dividend policy when making investment decisions. Management has to prioritize dividend payments to shareholders. A company's management should aim to pay a stable and increasing dividend over time. The payout ratio is the percentage of earnings that a company pays out as dividends. Investors should pay attention to the payout ratio when analyzing a company's dividend policy. A company with a high payout ratio may not be able to sustain its dividend payments in the long run. A company that cuts its dividend may signal financial trouble or a lack of confidence in the company's future earnings. Managements should avoid cutting dividends unless absolutely necessary. Shareholders have the ability to influence a company's dividend policy through their voting rights. Shareholders and managements. Voting rights and other proxy problems. Shareholders have the right to vote on important corporate issues, such as the election of board members, executive compensation, and major mergers or acquisitions. Shareholders should exercise their voting rights to hold management accountable. Proxy problems occur when management attempts to manipulate the voting process to maintain control of the company. Examples of proxy problems include insider voting, where management uses its own shares to influence the vote, or ballot stuffing, where management solicits votes from people who are not actually shareholders. Investors should be aware of proxy issues and should vote in a manner that best reflects their interests. Shareholders should also support measures that increase transparency and accountability, such as requiring independent directors on the board or limiting executive compensation. Investors can work together to influence voting outcomes by forming coalitions or shareholder groups. These groups can pool their resources to hire proxy advisors or to initiate shareholder proposals. Margin of safety, as the central concept of investment. Margin of safety is the difference between the intrinsic value of a security and its market price. It represents the cushion or safety net that investors have if the market price were to fall. It provides a measure of protection against the potential downside risk of investing in a security. Investors who focus on margin of safety can limit their losses and increase their chances of long-term success. To calculate margin of safety, investors need to determine the intrinsic value of a security through fundamental analysis. This involves analyzing a company's financial statements, industry trends, and competitive position to estimate its true worth. Once the intrinsic value is determined, investors can compare it to the market price and calculate the margin of safety. Investors should only invest in securities that have a margin of safety of at least 33%. This means that the market price should be at least 33% lower than the intrinsic value. By investing in securities with a sufficient margin of safety, investors can protect themselves from losses due to market fluctuations or other unforeseen events. Be intelligent and subscribe to Illustrated Books for new learnings weekly.